need to.
Okay, well, let's go ahead and get started, and we'll work on Bob Hamilton's technical issues. But hey, this is Rich Swerbinsky with the Mortgage Collaborative. I want to thank everybody for joining us this afternoon. Start of another week. I think this is what, week 8 of the quarantine? Is this, I think so. It feels like about week 86, but, and we're here to revisit the issue of just forbearance in general. We've done, I think now 3 or 4 of these servicer roundtables, calls that we're setting up here just to talk through the most pertinent issues that mortgage servicers are dealing with. Have our members talk through the experiences they're having with their borrowers, forbearance levels, best practices, strategies. And we have 3 outstanding discussion leaders that we have today to help guide us through the discussion. Amy, if you can advance the slide. Okay. Bob Hamilton, who many of you on the line may know. Bob's been a very regular contributor to all the different servicing related sessions that we've done here at TMC, both in person at our conferences and here on TMC Connect. We're working through his audio difficulties right now. Another person that should be no stranger to the TMC community, Anita Padilla-Fitzgerald, who is the president and CEO of Megastar Financial out of Denver. Hi, Anita. Anita also, some of you know this, some of you may not know it. Anita also owns, she was joking that she's bad with technology, which we know is a lie because she owns a technology company called Take 5. And the Rule Tool, who many TMC members use, is actually one of their products. So Anita's got a big tech background and runs a mortgage company that services but uses a subservicer. And what subservicer was it again, Anita?
Cenlar.
Cenlar, gotcha. And then John Williamson, who is the Vice President of Servicing, Senior Mortgage Loan Operations Manager for Johnson Bank, based out of the Green Bay, Wisconsin area. Another longtime TMC member. John, thanks for agreeing to help lead the discussion today.
Glad to be here.
All right, let's get into it. So these are some of the topics that we are going to discuss today. And as everybody on the line should know by now, please, we want your feedback, questions, experiences. We've muted everybody's line, but you can opine on anything we're talking about or things we're not talking about through either the chat or the Q&A function on the site. And please don't be shy in doing that. We want your feedback as well as part of this call. We will also send a copy of this recording and a copy of this presentation to all registered attendees upon its completion. So, okay, moving on here to the next slide. Okay, so communication in general. I want to start the conversation, I guess, just by talking about how our discussion leaders are handling communications related to forbearance, both internally for their teams and then externally to their customers. Anita, I'm going to start with you, and we have some examples there in the presentation of different types of internal communication related to forbearance. In general, if you could provide an overview of how you've handled internal communication on this topic with your staff at Megastar.
Sure. So a couple of things. One of the first thing we did is we sent out a email blast regarding forbearance to all of the clients that were in our database. So we were making sure they were aware and they understood what COVID forbearance was. People felt like they heard on the news that they could miss mortgage payments, but they didn't realize the repayment terms. So it was important for us to make sure that, number one, we sent a blast out to let people know that once your loan goes, if you apply, which there's not much to apply with regard to just the certifications that you have been financially impaired, due to COVID by just financially impaired. They didn't really even go into much more than that. But specifically, the thought was if you lost your job, had a reduction in hours, or you were caring for, or you were sick or caring for an immediate family member that was sick, that the government didn't want people thrown out on the street, so that they would allow them to do this forbearance depending on their situation, 3 to what I understand up to 12 months. What they didn't understand was the repayment terms, that after the forbearance that you would have loss mitigation, which would potentially be a lump sum payment or a note that you would carry for a period of time, or that you would go into modifications. The second thing that we did is we wrote a script for the loan officers to save as an Outlook signature, letting people know and helping them understand what forbearance was. Then we posted to social media how forbearance worked, and that if you go into forbearance, that you're not qualified to get a rate and term or any kind of loan. If you put your mortgage into forbearance, you're now disqualified from getting a new loan.
Thanks, Anita. John Williamson at Johnson Bank, managing the servicing team there. I guess talk about your communication strategy with your internal staff and how that's evolved over the course of the last 5-6 weeks here.
Hey, Rich, this is Bob. Can you hear me?
Bob, all right, you're on.
I'm
Get
back.
ready. I'm coming to you with a question soon. So,
Evolution is a great way to put it, Rich. It really has been an evolution with the various teams within the organization. So we're a community bank, so we have a central call center for all of our bank customers, if you will. So we wanted to communicate with that group because that group is our first line of communication from the telephone with our customers. And then the way we're set up is we do warm handoffs to our servicing SME group if they are questions that can't be answered by that call center team. So we educated the call center team on the appropriate resources. And then, of course, we had meetings with our servicers who then take the escalated calls. But the primary team designated to deal with the COVID-19 accommodation questions are our non-performing loans group. So we tend to shift most of those communications inquiries into the funnel to go to that team. So we've activated all of the non-performing loans associates, whether they're primarily responsible for default reporting, they may be working on foreclosure, bankruptcy, whatever it may be. Everyone is queued and been trained to take inbound phone calls. Then our outbound calls are primarily handled by our collectors and our loss mitigators. But then we had a significant number of inquiries coming through our loan officers. So we had to develop a kind of a scripting for them when they're dealing not only with their customers, our borrowers, but also they started receiving a number of questions from realtors, builder contacts, even title companies. So we put together communications that they could share with that team. Similar to what Anita experienced, the majority of our questions were related to what happens at the end of the forbearance. All types of feedback from customers. I'm sure everybody's getting the same thing, but customers also wanted to know about late charges. Are you going to be assessing late charges? Are they going to stop? Would they still continue to receive billing statements on a monthly basis? And then confusion over why am I going to get a statement if my payment's not due for 3 months or for 6 months? So we would go into explaining the CFPB rules on monthly billing statements. We've elected to try to halt the generation of late charge notices But our monthly billing statements are still going out to the entire mortgage customer base. So I imagine that's very similar to most of the other customers or lenders and servicers on the line. Our call volumes peaked 2 weeks ago. We have significantly tracked call volume, email volume, quality right party contacts that we've made with customers, everything that you can think of. But we saw a peak actually the first week after the CARES Act was signed. The week thereafter was very heavy, and then we've seen a slight decline each week thereafter. So we're currently operating at about 56% of customers we talk to have elected to go with forbearance. So a large chunk of that group has elected, based on a better understanding of what really is involved, not to take forbearance.
Thank you, John. Interesting. 56% of all calls actually went into forbearance. If anyone else on the line is measuring it that astutely and can share your experiences in the chat, please do so. It'd be useful information to socialize with the group. Bob Hamilton, Glacier Bank Corp, holding company for 16 different small community banks in the Pacific Northwest.
That's correct, sir.
And I know we talked a few weeks ago. I want to say you said at the time, this was maybe 2 or 3 weeks ago, you only had only about 2% of Fannie Freddie loans you serviced that were in forbearance. We've seen the numbers go up over the course of the last several weeks. What has been your experience at Glacier?
We're still under 4% on our portfolio and our Freddie Mac loans. I'm very pleased to report that. Most of our secondary marketing loans, the loans going to Fannie and Freddie, are pretty recent originations, which I think that's resulted in our percentages being a lot lower. One thing we do is when we do get calls in from these borrowers, if the loan sold to Freddie or Fannie, and of course they're requiring forbearance on their loans, we're explaining to them very clearly that it's not a freebie and that they will be expected to pay back those 3 payments. And we almost try to talk them out of the forbearance agreement if there's a way. I mean, obviously, if they're unemployed, they can't make their payments, we're going to have to put them on the forbearance. But if they are still working and maybe just calling in to see if maybe they can get a better deal, we make sure that they understand that they are going to have to pay those back. Now, in our portfolio loans, we just got our delinquencies. Our delinquencies are actually down, if you can believe that. And then I started thinking about it. Well, that's because a lot of these loans that would have become 30 days delinquent are on payment deferrals, where we've actually advanced the due date on those loans to July. And again, those are on our portfolio loans. We'll re-am the loan if we have to. We have to put a slight balloon payment at the end of the loan. We're doing that, and that's worked out really well for us as well.
Thanks, Bob. And I know CNN ran a piece, I want to say it was Friday, that was like trending. It was one of the top news stories, just about, the different type of repayment options, for loans that go into forbearance, and how one was not kind of mandated by the CARES Act. And they were, I think the title of the column was, confused about mortgage forbearance, you're not alone. I don't know if anybody on the line has seen any uptick in call volume to your servicing centers this morning as a result of that, but I figured I'd note that. Anita, continuity of income, have you started to see, anybody, people starting to get back to work? I know Colorado, I think, was one of the states that is more ahead of the curve in terms of getting back to work. Any updates there?
My only update, we haven't really encountered folks getting back to work as of yet. Our state did open up somewhat a week ago with a lot of restrictions. Denver's still not open. We don't open for a few more weeks. Did I get that confused? No, Denver did open, excuse me, Monday, but with a lot of restrictions. So for Megastar, we're based in downtown Denver, basically. I pushed it back a month because there's so much we need to do as employers, taking people's temperatures, requiring that masks be worn, this and this and that. So we decided just to hold off. But as far as the continuity of income, what we're seeing right now is more of the SBA PPP loan, where employers applied for the PPP loan. In their certification, they say that the economic uncertainty made the loan necessary to support the ongoing operations for the applicant, and the funds were necessary to retain workers and maintain payroll or make mortgage interest payments, lease payments, utility payments as such. So we studied that a lot, talked to the agencies, and happened to have a $1.5 million loan prior approved by Chase. In our situation, in our QC, we call on the self-employeds now 3 days before closing, and we ask them if their companies were impacted by COVID or closed, and if they participated in the SBA PPP. So in this case, we had a self-employed borrower who, yes, had closed his company. We submitted the loan. We updated the income verification, the income documentation for that client. We sent the loan in to Chase to get it prior approved, and they approved it. So they felt that the customer had good cash reserves. So that's one example of a loan coming out of a self-employed business that was closed who reopened. I talked to Chase on it this morning. They said, again, they felt that it was a strong client, good loan to value, but their decision could have also gone the other way. So for us with the SBA PPP, that doesn't necessarily disqualify the client, but in accordance to Fannie Mae's COVID guidelines for self-employed borrowers, a letter of explanation from the customer as to why they got the loan, and then we're qualifying the client the full loan amount at 24 months amortization at 1% interest in case they don't pass the audit, and then they have to repay the loan. So they have to apply to get forgiveness, I think, between weeks 1 and 8. And if they don't get forgiveness, then they're going to have the payment. So to continuity, we felt we should include the 1% interest payment. So that's what we've seen so far. As far as employees coming back to work, I'm sure we're going to be looking for their employer to talk about the stability coming back and if they're able to validate the number of hours that we're using. We haven't, I don't know what we're going to do, honestly, on commission, bonus. If any of your members have color on that, we would appreciate knowing what other companies are going to do.
That's a great point, and something we should definitely address in one of these calls. A lot of members have, noted that they have clawback tenants, or we're putting them into their agreements, but we haven't gotten too much into the numbers. So that's a good point. John, and then I'm going to go to Bob on both these issues. So we have a new month now upon us, May, payments coming due. And we've seen the jobless claim numbers every week, new first-time jobless claims week by week. Those are new people that are out of work that in theory, and many of them may have made their April payment, but will be unable or unwilling to make their May. I want to get your guys' thoughts on, how you're kind of prepping your servicing staffs for that. The last numbers that I saw nationally were a little over 7% of all loans. I think Ginnie loans was a little over 10%. Fannie Freddie loans was a little over 5%, although Fannie, I think their CEO came out, I want to say on Friday, and said that they were at 7%, their own internal metrics, which were likely ahead of what we're seeing nationally, and that they were expecting that number to potentially double, which, you know, if they're saying they're at 7% currently, they're expecting maybe 14, 15%. John, and then Bob, will go to you with the same question. How are you looking at May here? You know, I know, John, you mentioned that call volume, it peaked a couple weeks ago, has declined a little bit. Do you expect that trend to continue, or are you expecting it to ramp up here with the new month upon us?
Well, I read today, and actually on the MBA webinar this afternoon, the pundits are indicating unemployment at 12 to 20% nationwide. We've seen our delinquency rise to 130 basis points, which is high for us. And call volume, it went up, looks like about 12% week over week, last week over this week. But again, the pull through on people looking for forbearance, it looks as though they're still fishing. In terms of what we're doing to try to prepare for if we really do get impacted by the unemployment. We have staff in our quality assurance areas that have been cross-trained in loss mitigation. So if we get into a bind, we'll be shifting those personnel and then having to look to expanding the QA relationship we have with our third-party QC vendor to handle that stuff.
Thanks, John. Before I go to Bob, Anita, we got a quick question. What advice can you give to IMBs who in that interim period before a loan is sold to an aggregator receive a call from a borrower inquiring about getting into forbearance?
Great question. So what my company's done is, as I'm sure you guys do, your LQI, which includes the credit refresh, we have actually changed our process so that I have a team that it starts at 7 a.m. and we have a report that they get of all the loans funding that day. So what we are doing is we first do our East Coast branches. So first of all, we send our wires out the day before on purchases like we always have, but we're instructing the title and escrow companies to get a funding number. And then the refis, we're wiring that morning for all refis. So at 7 a.m., our team in Colorado comes in and they do the East Coast purchases first, and we run the credit refresh, which I think is about $20, depending on how many borrowers. And we're looking for if people have applied for forbearance. So we are identifying clients that were in our pipeline where their forbearance was reported after their credit report and after the loan was underwritten. Now, Fannie Mae's LQI is 10 days, so in that period of time, you could see forbearance hit their credit report. So that's what we're doing to mitigate closing any loan in forbearance. The next thing we're doing on the refis, since those are not eligible, cash out refi is not eligible for sale. What we're doing on those is, as these loans, as our underwriters underwrite cash out refis, we're sending that to the head of operations, who has an e-signature that goes to the loan officer. And the loan officer is required to call the customer and just say, you know, hi, this is Anita with Megastar. Congratulations on your approval. As you know, we'll be closing soon. I wanted to know if I could answer any questions for you regarding forbearance, since there's some confusion with regard to forbearance. And they're talking to them about how forbearance works, so that hopefully we don't get stuck with a refi after funding, but before we sell it through the cash window to Fannie Mae. So that's how we are managing that risk.
Thanks, Anita. And yeah, for the gentleman that asked, it's probably been the number one of the top issues, just our members in general, you know, exacerbated more by our members that don't sell direct to the agencies, a little bit longer to get loans funded, a little bit more risk there, but something everybody is all over because of the obvious risk tentacles to it. Bob Hamilton, Glacier Bank, I want to hear, one, your thoughts about May, with May coming up and what it might look like in your world. And then you see also on the screen here a number of different reporting requirements related to servicing and delinquency reporting. In addition to how you're looking at May coming up, my buddy Paul Peterson over there, like, what's he looking for out of you as the head of servicing? You see some reports here on the screen that I think John Williamson put together that he's doing some of it above and beyond. Let us know how you're looking at May and how you're handling reporting and education of the rest of the bank staff.
Got it. So as far as May delinquency ratios go, like I mentioned previously, we just got our April month-end numbers in. I'm kind of where John's at right now. We didn't really see a big increase in delinquencies. Now, one of the things I will mention is our ratios are looking really good because we've been delivering a whole bunch of product in the last 2 months. So our number of loans serviced has increased. Just between March and April, we increased our portfolio by 1,000 loans. So obviously you increase your base, your delinquency ratio number is going to look better. So it's kind of deceiving when I say my delinquency ratio is going down because the number of loans we're servicing is going up, which is a good thing. I think we've peaked, at least in this area of the country. And you know, when you're talking delinquencies, it's really regional, depending on, you know, where your product is located, depending on what industries and where your borrowers are working. I think that really drives it. So it's going to be different depending on, I think, the location and where your lender's at. As far as reporting goes, we do both a daily and weekly report that gives senior management and executive management an idea of what we've got in the pipeline for COVID forbearances and deferrals, what our delinquencies look like from 30 to 60-day delinquencies. And like I said, those go out daily to them, and we compare our ratios to the MBA averages that they publish on a weekly basis. And the MBA, on their when they publish those, they give a ratio for IMBs, commercial banks, and mortgage companies, I believe, are the 3 categories. But like I said, we haven't seen a big influx in delinquencies yet. I did want to mention that I had a call with Fannie Mae on Friday about our forbearances, how to report those and that type of thing, because we've never done that before. They're considering these basically a natural disaster type forbearance, and that's how you're supposed to report them. They did mention that they are working on a payment deferral program where it wouldn't be a forbearance, and they're looking at, you know, doing like a balloon at the end of the loan. They hope to have that published, they said, probably in the next 30 days.
Thanks, Bob. John, this reporting slide, anything of note here you feel it's really most important to convey to our members that we have on the line?
Sure. I want to add one thing to what Bob said. I had a call with Freddie Mac on Friday also, and they are on that same timeline with Fannie Mae as far as the revised payment deferral program for COVID-19 borrowers. So it's good to know we're getting consistent feedback from the GSEs on those. From a reporting perspective, we're doing a similar thing. Reports are published on a daily basis for us, and they have daily change activity. It also has month-to-date activity as well as year-to-date, all related to COVID-19. And then with respect to our delinquency, we've got a tab that's summarizing for them the trend of the mortgage delinquency, 30, 60, 90 plus. And one of the things that we've put multiple codes into our system in order to track the different stages of forbearance or deferral on our bank-owned programs, whether we're in the process of completing that workout with the customer, or they've accepted it, or we've updated the system. So we can kind of see what our WIP is any given day on that progress. But we've also, based on CRA reporting for our regulator, being that we're a bank, we get CRA credit for all the servicing that we're doing related to COVID-19. So I want to make sure everybody remembers to capture that historically for whenever it is you're going to meet with your regulator next.
Thanks, John. And as we go on to the next slide here, Anita, another question came in for you, just asking if you'd be willing to share just some of the text for your LO scripting for speaking with clients about forbearance.
Yeah, I'd be happy to. I can email that to Rich, and I'll share the template that we're using for our loan officers specifically for their clients.
Excellent. Thanks, Anita. So, Anita, I'm going to stick with you here. A fairly large independent mortgage banking company based out of Denver. You guys service some loans and use a sub-servicer. We just hit on a few issues, kind of more related to banks or lenders that have in-house everything servicing teams. What have been, some of the top takeaways for you in working with the sub-servicer, and some of the things you feel like maybe it's most important for IMBs in your position to keep top of mind in working with their sub-servicing partner right now?
Well, I think I will say I think Cenlar has done a good job with regard to our ability to escalate issues to them. I really have no complaints. I will say one of the bummers, I guess, about using a sub-servicer or just this whole situation, and I would be interested in Bob and John's comments, but we've always done really well with our Google ratings and our Yelp ratings and all that kind of fun stuff, and this last few months has not been that situation because people are confused about forbearance. And I talked to one gentleman who made his automated payment, and then his wife made a payment, and then they thought they wanted to go into forbearance, but then when our team educated them on what forbearance was, they got mad. And because we couldn't give him his money back the same day, he posted a 1 rating and made some very nasty comments. But from a sub-servicer perspective, that's a challenge that you guys need to think about if you're going to go into sub-servicing. I don't know how you mitigate that. I think working with a company like Bob or John's, they have, the ability to manage that better. And I'm not saying that Cenlar did anything wrong. I think they've done a good job. They've kept our notes up to date. They've been great about providing us education. So that's really all I have.
Excellent. Thanks, Anita. John or Bob, any comments on Anita's comments and questions there?
It's a valid point. We've had a few of those situations. If we have all of our calls, of course, are recorded. So if we have a verbal confirmation from the customer that they want to move forward with forbearance, and they have been signed up for ACH or electronic payments, our process is to go ahead and cancel that next scheduled ACH payment. But we've had a couple of customers who came back afterwards, same scenario as Anita, changed our minds. So we've had to go back in and we manually can debit their accounts. So that does give us a slight operational advantage, but it happens in the banking world as well. So in terms of other staffing needs, we're trying to look forward to what happens when we get the wave for loss mitigation, because we're not really stacked up for that type of thing. But if we've in fact hit our peak as far as forbearance goes, we'll have no problems. But if for some reason we're in Wisconsin still on a stay-at-home order until May 26th. But if once we go back to work, we see a resurgence again of the pandemic, and we get pushed into another lockdown, and then our volumes perhaps would double or whatever. Fortunately, we've got other resources we can pull within the bank that can help us, but those are some of the things that concern us. The other thing is we've been trying to take advantage of video communication with all of our team members. So all of our supervisors, managers are reaching out to different people randomly every day to do a video check-in with them as a way to stay connected. We've had a few employees who've indicated they've coping with the social isolation because they're used to working with teams and collaborating and offering resources to associates. 201, all of my team members are really looking forward to getting back into the office.
Thanks, John.
Yeah, I'd add to that too. We kind of act like a sub-servicer here at Glacier because, as Rich mentioned, we actually service loans for about 16 of our division banks that we're the parent of. So we put out a separate email address and a separate phone number that all of the divisions and branches can funnel calls to and funnel emails to, so that we can, pay the attention that we need to these COVID-19 borrowers. I will mention one thing that we came upon was a couple of the states have come out and issued their own state guidelines as regarding, what beyond what the CARE Act says. We took the stance that any loan that we're waiving late charges on all loans for 90 days because it was unclear as to if you weren't supposed to assess late charges on loans that weren't affected by COVID-19 or just those that were affected by it. I'd be interested in hearing what other banks are doing or other mortgage companies are doing regarding late charges. The other question that came up recently is if you've got a delinquent borrower that was delinquent prior to COVID-19, prior to March, and now he calls in and says not only did he have the issues before, now he's got COVID-19, do you offer him the deferral and the forbearance? And we've been kind of mixed on that one because where do you draw the line, especially if it's a portfolio loan. If it's a GSE loan, whole different ballgame. But if you own that loan, why wouldn't you give a borrower that was delinquent prior to COVID the same benefit that you would one that was affected in March?
Thanks, Bob. We've got a few questions that have come in, and we've got about 8 or 9 minutes left here. So just a reminder, everybody on the line, if you have any questions, this would be the time to put them in, or your experiences on what you're seeing in terms of delinquency rate. Bob mentioned being curious on how lenders are handling late charges. Please, any of that feedback, we welcome it. You can do that via the chat or the Q&A function. Few technical questions that have come in here. When a borrower files for forbearance, you automatically send the bondholder 3 P&I payments, or is there a time lag? I guess that would depend on how you're structuring your forbearance. That would be, in that scenario, they're all due in 90 days kind of method. I'll voice.
If it's a forbearance plan, it's owned by Freddie and Fannie. it depends on how you sold that loan to that investor, you're gonna have to advance either interest or principal and interest for the 90 days. Unless you sold them on a cash basis where you just remit principal and interest as you receive it.
Actual, correct. And then,
Well, I'm going to tag on to Bob here. So the way the question was worded made me think that they're advancing 90 days at one time. So you're going to advance up to 120 days, depending on whether you're, how you sold it to Fannie or Freddie. But you're only going to advance, once every month up to that point in time.
Okay, that makes sense. John, one question that came in specific for you. How is the escrow portion of the payment handled if the interest is deferred and the term is extended or ballooned at the end of the loan?
That's a great question. We are not, unless the borrower chooses to do so proactively, but we are not having customers send in escrow-only payments. So it's a total payment forbearance or deferral. And on those escrowed loans, when those real estate taxes or insurance premiums are due, we will advance those out of corporate funds if that's what we need to do, and then include that as part of the restructure or the workout when the forbearance period expires.
Okay. Here's one. If the borrower files for forbearance and then changes their mind in the same month, is it possible to unwind it and not report it?
I'll speak to that.
Mm-hmm.
Our understanding is the FHFA is supposed to be issuing guidance on that this month. But our position is if they're in and out of forbearance, we don't know if there's going to be a seasoning requirement or what's going to happen. So I heard rumor that that a noted MBA person said 12 months. So my initial reaction to that was shocking. But when I thought about it, with modification, there's no seasoning, but in modification, you've been in modification for a period of time, therefore you have a payment history. With mortgage lates, they require, it hits your FICO score, and the whole subject is the payment history. So it's never happened, I guess, in our industry where people were in forbearance for 2 weeks or 30 days and out of it before the payment was even due, made their payments on time, and now they're out of forbearance. But from what I can, my understanding today is they're waiting for a directive. The agencies are waiting for a directive. We aren't going to fund those loans until we hear the agencies tell us that there is no seasoning or what type of seasoning, and my assumption is that's going to be based on what the forbearance history was with regard to seasoning. That's what I know.
Thanks,
That's
Anita.
what I've heard. I don't know anything. That's what I've heard.
And that is a question if you would have told me we'd be talking about that question 2.5 months ago, I would have told you you're crazy. Unique times indeed.
So, Rich, the other thing I just want to tack on to Anita. So when Freddie Mac changed their accounting system last summer, most servicers went to a daily reporting. Prior to that, we could manage the reporting of the loan being put in forbearance and taken out in the same accounting cycle. We've not experienced that. If I report on May 4th that the customer is now in a forbearance plan, and on May 20th, I reverse that code. That's one of those unknowns, if you will.
Excellent. Got just a couple minutes left. Had somebody chime in on the chat. Because reporting to either credit bureaus or FHA/ GSEs happens once a month, a borrower could request forbearance and then change their mind technically before any reporting occurs. Somebody asked a question about my Christmas lights. Yeah, I'm a year-round Christmas light guy. So obviously I'm not married. So that's the only way you get away with that. So, and then well, I think all of you have mentioned a MBA call from last Friday. I guess we'll just wrap up unless we get any questions in the last couple minutes here about if there was anything else notable from that call on Friday. From MBA related to forbearance servicing, so on and so forth. Bob, I'll start with you. I think you were the first one to bring it up. Anything else of note there for the members on the call?
One thing that I would just mention that I've heard, and it kind of makes sense, is I think we're really going to see a large increase in bankruptcies coming up. Because once these forbearance plans are over and these people don't go back to work, we've already seen an increase in the last couple of weeks in Chapter 7. So I see a large influx of BKs, unfortunately, coming our way again.
John, anything from you of note from that MBA call on Friday that's worth relaying to the group here?
Yeah, actually for me, it was a call with Freddie Mac as opposed to the MBA on Friday. One thing that they did confirm was that if you have a borrower who wants to drop PMI, Freddie Mac's requirements still, if it's related to improvements, they are still requiring a full appraisal or an interior appraisal. So if you cannot get that, then the borrower is just going to have to wait.
Thanks, John. Anita, any parting words for our members? About 60% are independent mortgage banks. Good chunk of them service using a sub-servicer. Any words of wisdom for the group before we depart here?
A couple of things. Number one, I sent you my forbearance communication, so you should read it, have your legal team read it. It's just what we know. We're not saying we're right or wrong. It's what we're using, but I provided that to Rich already. You know, with regard to your sales force, do they understand that forbearance is an early payment default, non-performing loans? So I don't know what your contracts are, how your commission structures work as far as those clawbacks are concerned, but just, you know, heads up there that the loan officers if that's how you work with those are, in our opinion, early payment defaults, non-performing loans.
Awesome. Good stuff. Want to thank everybody for taking the time out. We are going to redo this session. I haven't decided if we're going to do it next week or the week after, but I do feel like it is good and we're getting great feedback and attendance on these calls. Just, you know, kind of every week or two check-in. Servicers experience with forbearance. I want to thank Bob Hamilton from Glacier Bank, John Williamson from Johnson Bank, and Anita Padilla-Fitzgerald from Megastar Financial. Thank you all very much for taking some time out with us this afternoon. And again, we will follow up and send the recording, Anita's script, and the copy of this presentation to all of our registered attendees. I think we have 3 TMC Connect calls tomorrow and 3 on Wednesday. And I think we're taking Thursday, Friday off because our team has like a big couple day meeting. But next week, we're already starting to line up 10, 12 calls on all the topics most pertinent to you guys. So keep the feedback coming. Appreciate everyone. Have a great rest of the afternoon and evening. And we'll see you all again very soon, hopefully. Take care, guys.
Bye-bye.
Take care.